Hi, I'm Cheryl Sorensen. I'm with Prosperity Bank, and we offer all different types of mortgage loans. Uh, we offer both the sellable and the portfolio loans, and we'll go into a little bit more about that on down the road. But I'm excited to be here and to share with you. I've got a lot of years of experience, and they take all of those into consideration. And we're going to go, I guess, straight into ratios and how the bank determines what your affordability is. And on the affordability, when it's measured, um, when it comes to mortgage approval guidelines, there's two ratios: the housing ratio and the debt to income ratio. The housing ratio is your front ratio, as it's known in the industry, and the debt to income ratio is known as the back ratio. So you have the front ratio and the back ratio. Next slide. So the front end ratio is the housing, and it only looks at whatever the housing related debts are. So your housing expense is your loan, your property taxes, your homeowner's insurance, and whatever, if you have a homeowners association. I think the little icon there shows a swimming pool. Um, and they add all those up together, and that's your monthly housing expense. And so an example would be like if you had a loan that was $2,000 and you added your property tax, insurance, and your swimming pool or your HOA fees to it. Say it came out to $2,000 total. Say it was $1,500 for the loan. Then you have your gross monthly income, and let's just assume for example's sake that was 6,000. You would divide the 2,000 by the 6,000. You multiply it times 100, and that gives you your ratio of 33%. And the average housing ratios are calculated between 31 and 33% of your gross monthly income. So what it's saying is, if you took a pie chart and said, a big circle, and said, this is your income, they're not going to let you spend more than 33% on the house, because you've got to have the remaining in order to figure out how you're going to put things like gas and transportation, food, and other expenses. So you can't spend all of your income on the house. Next screen. If you go to your debt to income, or the back end ratio, that's where we take and add in your house that we just talked about, the house expense, and then we add all your other monthly obligations that you have outstanding that you owe on a monthly basis. Your credit cards, your car, your student loans. You've got all of your anything else that you would have out there that would appear on your credit report, are going to be your monthly ongoing expenses. And then you would divide the total of those again by your gross monthly income, and again multiply times 100, and it'll give you that ratio. So in this case, the example that I used, if you took like 2,700, say, total, and divided it by the 6,000 times 100, you would get your 45% debt to income ratio for your back ratio, which is the maximum that they would. And that sounds a lot complicated. There's also, most lenders, definitely we do, if you go to, you don't even have to log in. There are calculators that will do this math for you. You can go to a website, to Prosperities, and there's three little lines out to the side. Click on those, click on mortgage, and then click again on the calculators, and it will do all of the math for you. And those are good tools as well. Next screen. Common types of mortgages. There are two types of mortgages that are out there, the conventional and the government. And both of those, a conventional loan is any mortgage that's not insured or guaranteed by the government. These are loans that are put out there by anybody and everybody else. The government loans are government-backed mortgages. That means that they're insured by an agency of the federal government. The conventional loans are riskier. The government loans, they have three types: FHA, VA, and USDA. The FHA is the Federal Housing Association, the VA is the Veterans, and the USDA is a rural or an ag type loans for it. They all of these have different requirements. They have, the conventional loans have strict eligibility, such as higher credit score and lower debt to income ratios. They have private mortgage insurance if you put down less than 20%, but they allow you to remove the PMI, the private mortgage insurance, once you pay the loan down and your loan to value gets below the 80%. Once you met that 20% down payment. The government loans have, of course, the lower credit score requirements. They require 3.5% down payment and an upfront premium of 1.75% of the loan amount. Now, in both of these type of loans, there are fixed rate or adjustable rate. And the fixed rate or adjustable rate, directly correlates to the interest rate, and is what they're talking about. And the fixed rate mortgage is a loan where the interest rate on the note is the same from the first payment to the very end, the maturity of the loan, for the entire term of the loan. The borrower is protected from sudden and potential increases or fluctuations. And there's sudden increases in monthly mortgage payments if the interest rates rise. It doesn't necessarily protect you from other increases in your taxes or your insurance, but it does keep your mortgage payment itself, the P&I, the interest rate will remain fixed. Your adjustable rate mortgages do not have a fixed interest rate. The rate changes during the life of the loan. It can be a good idea if you're likely to change in the next few years. You can enjoy most of what they call an ARM is adjustable rate mortgage, and they usually have like a 1 year, 3 year, 5 year, 7 year fixed rate period before they become variable and then go up and down. And during that time, if you're going to say you were buying a house and you're going to move in 3 years, you might enjoy the fixed rate period for 3 years, but knowing that you were going to be relocated because of work or whatever the circumstances were that you would be moving, that the ARM program might be good. But if not, then you would have to look at refinancing at that point more expenses involved. Next slide.
Cheryl, before we advance on this particular slide, I want to take an opportunity to ask a question on behalf of one of our attendees. So, Miss Lakeisha, her mom is a surviving spouse of a veteran, and she is wondering whether she would qualify for, whether she and her mom would be able to qualify under the VA loan together if mom cosigns or is the primary borrower.
If the mom, she's a surviving spouse of a veteran, that would be determined through the VA. And we could certainly, I can get her the information and we can go through it. As far as it depends upon whether, I guess with the VA, if the veteran had used his VA benefit and
Hmm.
obtained a VA loan before or not. But it's something that you know we could certainly look at.
Okay. And in the chat, she followed up, Miss Lakeisha followed up with, does she have to be a primary borrower? Or, Cheryl, does that kind of lend itself to first we would need to verify if there's even a VA loan benefit still available?
I would, I would, I would assume that she would have to be a primary borrower
Hmm.
because I don't think you can transfer VA benefits to non-VA. But I don't know for sure.
Okay.
We could
But the source
definitely.
would be the VA, Veterans Affairs.
Right.
Hmm.
Yes. And
Okay.
they typically it's for veterans only, and again for their spouses. And I don't know that. Like I said, I will have to check with our underwriting department.
Hmm. So, what does that look like in terms of having? What can you explain the difference between a consultation and actually applying for a loan?
Um, well, in order to apply for a loan and a consultation, we require only three pieces of information. We just need a name, a phone number, a good time to call during the, whenever it's most convenient for them to call, and an email address. And I can have someone reach out to her directly and, kind of handhold her through all of the questions that she would have with
Awesome.
regard to the VA loans.
Thank you so
Because we have
much.
specialists for all of them. Thank you.
Yeah, she says also in the chat, she typed in thank you. So thank you, Miss Lakeisha, for asking that great question.
Uh huh.
All right.
Okay, the next screen. Oh, and we're going on to the next screen is the lending team. Okay, this is the exciting part, and sometimes it can be a little overwhelming for first time home buyers because they say you start out and you have a loan officer, and the loan officer performs the original loan origination functions for the lender. Um, the loan officer, the loan processor, and the underwriter all are employed and are related to the lender. But the loan officer gathers the client's financial information, your taxes, income, credit, to see if you're eligible for the loan. They also complete the mortgage application form. The loan processor is the person who assembles, administers, and processes the application. They make requests and collect the key documents as well and ensure the loan gets to the finish line. They're kind of like I guess, the little quarterback in the group. Um, the underwriter is a financial expert who reviews the finances and assesses how much risk that the bank or the lender will take if they decide to give you the mortgage loan. Most specifically, the underwriters evaluate your credit history, assets, and the size of loan. They're the ones who look into all the details and how well they anticipate that you can repay the loan. They approve or deny the loan application. The other key partners your lending team works with is the title company. The title company is the entity that what they do is they are the actual insurer. They insure that the entire mortgage, they're issuing insurance saying, we've researched the history of the property, the house, we're ensuring that everybody's doing what they're supposed to do. And they keep everybody in line. The appraiser is the player that is out there and they look at the market and determine whether how much the house or the property that you're buying is worth compared to what's happening right then within the market with comparable sales and what building materials were, how much square footage you're purchasing, all the above. The surveyor is another player in the group, and they're the ones that actually draw based upon previous records and historical things, and that's your sketch, your picture of the property that shows the delineating lines and boundaries, so that you know where your property starts and where your property ends. And that's also, the appraisers, and everybody works together so that the appraiser knows how many square feet you're purchasing, so they can calculate how much the property's worth. The surveyor is telling the appraiser how much it is. The title company's insuring it. But if you go back to the very beginning, to the loan officer and the loan processor, you're handing information over to them, and then in turn they're sending it, and they're distributing some of the information, such as the property address and zip codes and this and that, to all these other people. And it's a little bit like playing phone tag. Sometimes because of technical things or whatever, some people will ask for more information, and it's like, I've already given this to somebody once, and it's just patience with it. And so we're going to go then to the next slide, which is documents. And this is where your job comes in. We have to go through, and it's important that you have a file. And I would recommend, this is just a personal recommendation, but I would keep a folder with paper so that you have easy access to all of the things that are listed. And you're going to want to keep those, I mean, just to have anyway. But if we start at the top of it, you've got to have a valid driver's license so we can identify, so they know who you are. You need 2 months of bank statements, all pages. It has to be on the bank statement. Can't just be a print off from a computer that doesn't have the bank's logo or whatnot. It has to be an actual bank statement. And we need all accounts, and that includes, if there are brokerage accounts or stock accounts, like, I don't know, an example in E-Trade or something. But all your checking, savings, and if you have your retirement accounts. If you're in a 401k, we're going to need the copy of the 401k statement. So when it says all accounts, it meaning all accounts. You need a copy of a divorce decree, if that's applicable. Your military or your veteran, this is that DD 214, if applicable. You're going to need 30 to 60 days, your last pay stubs. So a lot of those can be pulled off of online for those. And then your past 2 years of W-2s and a full federal tax return, and that includes all the schedules. Even if it looks like it doesn't have anything on the page or any numbers in it, we still need every single page of the federal tax return. Documentations for other sources of income. If you're receiving Social Security benefits, then you need your Social Security statement. Pensions or disability, same thing applies with child support. Then for self-employed borrowers, you need a year-to-date profit and loss statement, a P&L, income statement, the income and balance sheet there, and your business tax returns, including Schedule C's and all the other schedules. And if you have, K1s that are in there, if it's not, then you can do that, as well. Documentation pertaining to any resolved or unresolved credit disputes. This is with regard to your credit report or any other, if you've been involved in some other legal dispute. A fully executed copy of the sales contract if you're buying a property. in this case, you would. You need your realtor will help you in preparing that. A copy of a canceled earnest money check, which is that's whatever you're putting, in escrow with the title company. A copy of the settlement statement if you've recently sold a property. So and I don't think that the last one is really applicable if you're in a first-time homebuyers class, but um, anyway, again, if you keep all of this information together, because at some point somebody's going to have to get their hands on, like, just let's start at the very beginning with the driver's license. You send the driver's license in and you say, I sent it in with the application, and they have it. Well, then somebody else, the title company, says, oh, I need a copy of your driver's license. Well, if you have that and it's copied, then it's easy to email it or send it or get it, and you're not having to wait on somebody who may be at lunch or out or whatever. It makes the process move smoother, and if you have it all right there at your hand, you can say, well, I sent this too, and you have a copy of it in your computer or on your phone or wherever it is. Anyway, next screen.
Hey, Cheryl, I thought of a great question.
Yeah.
When you are working with a self-employed individual,
Uh-huh.
how many years do you normally require? And then what does it look like? Like, what's the benefit, I guess, of reading through the profit and loss statement and understanding, the deductions and how they play into your overall income?
Well, that's a good question. And for the self-employed borrowers, we normally ask for two, sometimes three. It depends upon whatever's going to benefit really the borrower, because you want to see, a trend of increasing income, or not that it's been very erratic, because then they're going to have to possibly even take an average to get to an actual income, or whatever the last income was, you want to be the highest. With regard to those, how we look at it and why we want to see the profit and loss statements, there are things that you can add back in. We have what they call add backs for considering cash flow. And if you're self-employed, then you probably from the business tax returns understand that those things, if you have depreciation or interest expense that you can add back in that are business related and whatnot, that you can add it back so that you're not being penalized for that.
Okay, so if I'm earning, let's say I go and apply for a loan with y'all's bank and I'm
Mm-hmm.
self-employed, if I'm telling you my business generates $100,000 a year, but my tax return from 2020, what was it, 5, says that my income, my gross or adjusted income is like 25K, do you honor my 100K that I earn?
We take into consideration the it depends. Like I said, there are things within there are things no, because you have a cost of goods. If you sell $100,000 worth of something, and that's what your income is, um, but you have to take into consideration what it costs to actually produce that whatever you're selling. So even if it's so if it's a widget and you sold this whatever it is, like I said, you have to take into consideration what it's costing you to make it
Mm-hmm.
in order to sell it. And so the difference is your actual income, but that's your adjusted gross income. That's not your gross.
Right.
And so we can add it back.
Okay. Well, thank you for clarifying that. I
Mm-hmm.
also wanted to ask a quick question because we talked about credit, credit, credit the last chapter. And one of the check marks on here says documentation pertaining to any resolved or unresolved credit disputes. So to my class, remember what we talked about with the credit disputes? One of the things, Cheryl, I shared was how if I'm in the middle of a dispute, it could slow down my loan application until the that is resolved. Is that right?
Yes. And the same thing applies if you have any legal disputes. If you're in small claims and you've got some other things that the title company might actually come across that would affect your ability to purchase. So yes, you need to be conscious of whatever you're, monetarily that you're having a dispute or a conflict with someone over.
Thank you, Cheryl. One last question on the divorce decree. I have a lot of clients who may have, been separated or want to purchase the home with a non-purchasing spouse. Can you share information about what that means for a lender in terms of a non-purchasing spouse or separation?
A non-purchasing in Texas is a community property state, which in the community property realm, it means that everything is 50-50. Everything is shared. So um, basically, if you're, first of all, I don't think you're either married or unmarried in Texas. Um, and secondly, I believe that if you, um, when you get ready to purchase something, if you're separated, this other person doesn't necessarily have to be on the note with you, but they would have to sign the deed of trust, meaning they would have to acknowledge the fact that, and even if they're not contributing to it monetarily, and you generally don't want to go into that until, so if you're in the middle of a divorce, you kind of want to make sure it's finalized before you would go into that.
Okay. Thank you for clarifying, Cheryl.
And the same thing applies though if you're in the process and you're engaged and you're going to get married. That would be another thing that you would want to tell your lender, because whether this person is going to be on it or not that's a big decision too.
Right, and then
They're
there's
going to contribute to monetarily, and there's a lot of other circumstances that, on
it.
down the road that.
I remember seeing on a loan application something like, is there a significant other who has the same rights as a spouse or something like that? Is that what you're referencing? So you can have a domestic
Yes,
partner, you can file taxes together, and that's in Texas recognized as a marriage.
absolutely.
Okay. All right. So you guys have Cheryl. Her experience is awesome. And so I encourage you to ask your questions, drop them in the chat. I am monitoring them. I do have one question from Melissa. Miss Melissa, I'll come back to it. And then one quick question here, since we're talking about underwriting, I will ask from Stephanie. Stephanie asks, are a home buyer's numbers ran through an automated underwriting system when they apply for a home loan?
No, they're not. We have actual underwriters, in-house underwriters that are going through these, but that doesn't mean that they're not. When they are run through, it doesn't mean that they don't have to follow whatever guidelines are set out by either the government entity, or if it's a conventional loan on the conventional side. They all have policies and procedures that are not really flexible. They're pretty much uniform across the board.
Yeah. We talked a little bit about the Truth in Lending Act too, and yeah,
okay.
so that definitely we've touched on the FCRA, FCBA, FACTA, and so we've talked a little bit about those. Yeah, up until this point, and so they're ready to become lawyers. One thing I'll say on the Underwriting, like Cheryl said, that it just depends, it varies. There's a separate bank that I'm familiar with that does use AI to drop in, obviously, like Cheryl said, there's policies and procedures that protect consumers' privacies because those are rights. And so they drop it in to calculate your DISC. So they are calculating debt, income, savings, credit, and they're also calculating the four C's of credit. So capacity, collateral, the four C's that Cheryl just talked about. Like this AI machine, I guess, calculates like your overall riskiness as a borrower. So maybe your credit is slow and you have some charge-offs, etc., but your savings are really high. So this AI tool, remember I told y'all that there was one that was like $130 for a credit report? That's that report. But it definitely gives you an increased opportunity also to just see not that you're not able to see it with like underwriting in general, but I guess for them it just allows them to move quickly with the volume of clients that they have. But it just depends on the bank that y'all use. And
That's
what,
right.
yeah, and then why it's important to ask what is my credit report fee to finance a loan with y'all, right? So.
And there are there's different types of lenders that are out there too. You've got we are a regional bank. We're a large regional bank, but there are smaller community banks, credit unions. There are national sized banks, and so different. I'm assuming that each one uses different, just like they use different operating. Everybody uses a different operating system in their
Mm-hmm.
way they process.
Yeah. Okay. Thank you, Cheryl.
Mm-hmm. Okay, so here, this is a good one. Why is it so important to be pre-approved? Number one, a mortgage pre-approval isn't a promise that you're going to get a loan from the home loan that you want to buy. A mortgage pre-approval means only that a loan officer has looked at your finances, your income, debt, assets, credit history, and determine how much money you can borrow and how much you could pay per month. A pre-approval suggests you pass the first step in the screening process. And the pre-approval, and why is that important? Well, number one, there again, number two, it tells you how much you can afford and allows you to look for houses within your budget. I mean, we'd all like a Ferrari, but sometimes when you get ready to buy a car, you
Are y'all
know
learning a
that,
lot?
well, maybe
You're learning a
all I
lot
can
too.
afford is, a Volkswagen. And that may not be a great analogy, but it's kind of the same thing here. And that this is why the pre-approval is so important. And also, um, the letter doesn't bind you to any lender. Just because you get a pre-approval from one doesn't mean that you can't go to another one. So it's again like, and this is not maybe the best analogy, but I do have seen it, and that is, if you go to 5 different car dealers and they all do hard pulls on your credit, it directly affects your credit score. And so this is a one hard hit, and then you can go shop with other lenders and talk to them about it. Your pre-approval lasts for 60 to 90 days. That gives you long enough that, again, you've just provided them with 60 or 90 days worth of your income, and that way things can change within that period of time. It establishes your credibility as a home buyer. A mortgage pre-approval shows the sellers that you have your finances in check, and that you're serious about buying a house, and that you're not just what they call a looky-loo or just a looker, that you're just browsing, and that you won't be denied a mortgage if they decide to sell a home to you. So it makes the sellers feel more secure, and it's in your best interest to get that pre-approval so that you can then shop with ease. And next screen.
We talked about window shopping, so I'm so happy to hear you say looky loo.
I'm sorry. I'm trying to
Yeah,
not live too much.
love that.
Yes. Okay. The mortgage loan application. Um, okay, so once you have shopped, and actually, this is my dream home. But you have now found the house, so to speak. You. This is what I want. You found it, and at this point, you've executed a purchase agreement, meaning you've now signed a contract and put up some money and said, "I'm serious, and I want to buy this house." So you sign the purchase agreement and complete the full mortgage loan application. The lender will request updated documents, and if it's been, and this is when it says again in parentheses, that's where I'm like, you can go back and say, okay, I just gave them 2 months worth or 3 months worth of pay stubs. Well, now I'm going to have to make sure I got the next couple of them. If it's depending upon how long the time gap is, but you can go back to your list and go through it and say, okay, well, I've given you this, this, and this. Now all I need is this or this. Meaning, okay, I've already given you a month's worth of pay stubs, and I found the house in 2 weeks. So here's the last pay stub, and you should be able to get it. But you have it all there together somewhere and know what you've provided. And then a few additional documents will now be needed to get a loan filed through underwriting. You're going to receive a loan estimate within 3 business days, which will list the estimated rates, fees, and terms of the loan that you're being offered. Next screen. The loan estimate. What is a loan estimate? The loan estimate contains 3 pages of detailed information about the mortgage term, closing costs, features of the loan program that each lender offers. Again, we're going to get that to you within 3 days, and that's mandatory. If we don't produce this within a 3-day period, we can be in trouble with fines and everything else. Can the loan estimate change? Technically, a loan estimate is only binding on the date that it's issued, that day. Interest rates change every single day. So if you don't lock your mortgage rate in with the lender the same day you receive the loan estimate, the interest rate and terms and closing costs can change. And a good analogy of that is you look at the stock market. The stock market changes, so do interest rates. And so you want to lock your loan rate. If the interest rate's high, if you think the interest rate's going to go up, then you might not. But those are scenarios, and that's something you can talk to your realtor about, you can talk to other people about, and you decide when you want to lock it. But know that it can change, and it's going to result in a difference between your initial loan estimate and whatever the final estimate is, such as and the other things that can change that is your credit score, or if your debt changes. And with the debt changing, another thing, I don't know where you were with, but one important thing is from the time that you make a loan application, you get your loan estimate, it's important not to make any large changes to your current credit position. Meaning, don't buy a car, don't buy furniture for the new house, don't go shopping, because it will seriously, it can change not only the interest rate, the terms, it can actually, at some point it could, based upon those initial ratios that we talked about, it could keep you from qualifying for a final, because this is just what it says. It's an estimate. When you receive a loan estimate, the lender's not yet approved or denied the application. Next screen. The sample, this is a sample of the loan estimate. And if you look at it, the first portion up there just has when the date that it's issued, and then it has your information, and then the property where you're going to purchase, and then how much that contract had agreed to purchase the property for. Then the next line is and they have to have that. They're not going to give you an estimate of what it's going to cost until you have all the things that we first talked about. The amount that you're financing is the amount. If you notice in the example, the sales price of the house was 180, but the loan amount's 162. The difference between those two is your down payment that you're making. So the actual loan amount with the bank, because the bank isn't normally going to finance 100%. Remember, we talked about the 20% down to avoid the private mortgage insurance, but if you don't have that, then you go forward. The next is the interest rate. This is this example here is 3.875, so evidently this slide was done some time back. But your monthly principal and interest payment is calculated there, and many times the loan amount may not include any down payment assistance. That's important to know, because if you are qualifying for down payment assistance, that would be may not be included there. So and then the estimated taxes and insurance. On down, there's your principal and interest. Your principal is the amount you borrowed. The interest is the amount that you're paying for the loan. Those two together are your what they call the P&I payments, or your principal and interest payments. Your mortgage insurance, your estimated escrow. That amount can increase over time. And when I first started talking, I said, when we were calculating the front ratio, your property taxes go up when your school taxes, the county taxes go up, and those are things that you go to the polls and vote upon, but when they come back down, they can increase those in order to provide for streets and lighting and whatever all else. And those are things that are not really within your control or the lenders or anybody else's. It's just, but those have to be, you got to pay your taxes, and you have to insure the property. That's your estimated escrow. And then that's your total monthly payment. And then that's an estimated total monthly payment. So you can see that's quite different than the actual just principal and interest amount. And then the estimated taxes, insurance, and assessments, that's your homeowner's insurance. And they're estimating that as well. There's your $206. And that's just the taxes and the insurance. And your insurance is your liability insurance, and what that does is it covers, it protects you and it protects the lender in case there's damage to the property. And it could be, damage as far as wind, hail, flood. It could be, anything that happens, somebody falls down, anything that happens, broken windows, like I said, wind, storm that damages the roof. There's all kinds of things. But so it's very important, and it's necessary the entire time that that's maintained throughout the life of the loan. And it's in escrow, and that's why. And that's, they collect it monthly.
Cheryl,
Okay.
will lenders require the one thing I mentioned earlier in the class was a minimum dwelling coverage?
They want the minimum dwelling coverage to be equal to or greater than the loan amount.
All right. And then we do have a few questions related particularly to this part of the slides. I do have a few other ones, but I will hold those until the end. There's a
Okay.
couple questions. Says Stephanie asks, when I fill out a mortgage loan application for a mortgage pre-approval and or pre-qualification letter, we will have to fill out another mortgage loan application after I have a home under contract? Question mark. Will my credit be pulled again? And will I be charged for another hard credit pull? So here, I believe that the question, just clarifying the question, is when I get my pre-approval and then have to go back to you and say, "Hey, I'm ready to finance," am I going to have another hard credit score impact?
it depends. Remember, we said that when they pull it, when you get the pre-approval, that's from one lender. You're free to shop with another lender, but yes, at that point, when you make your final decision to do a formal application, then it's going to depend. If you go back to the same lender and it's been within a designated period of time, it's like it's no different than having to provide additional documentation. It's going to depend upon the length of the time from when the pre-approval was done and to when the actual loan application is made.
Okay, so the second question to that is, will I be charged again for another her credit pull? So what I'm hearing is, yes, if there's a separate bank that that you finance through, like you can get your pre-approval
Correct.
from bank one, but you can then maybe wait 60 days to find a property, and then with that same pre-approval, another bank can finance the actual loan for the property, and they would need to do another credit pull, right?
Correct.
Okay.
Correct.
So emphasizing that there should not be any hard inquiries other than your loan applications during this time. Reducing debts and increasing savings will be our goals during this time. So, Miss Stephanie,
Yes.
that will answer your question. Is the depending on the time period, right? That you take the depending on the time that you take to find a property and take it to closing will depend on whether you need to do a hard inquiry again. So what we
Right.
really drilled in, Cheryl, in the morning was following the home buyer steps really sets you up for a smoother transaction.
Yes.
Have you seen buyers like what I guess what's the rate of people that close on a home from like pre-approval to closing in 30 days? What would you say the rate is? Or frequency, I guess.
It's much more likely that if they start, they stay with the same lender and they go through the process, and it like builds momentum. And so I would say, almost all of them. Now, those that start and you stop somewhere because of a life event, and life events happen. I mean, things happen within people. You may, I don't know, things change. You may be signed up and think you're going to buy one house, and somebody ends up expecting another member of a family, and and you wait for another period of time. I don't know. But for the most part, if you follow the course and go all the way through, you should, and that's why it's important to go with the guys and get your loan as quickly as you can locked in, because as we all know, there's not only do your life events and things change, but things change within unforeseen things within the market.
Mm-hmm.
It's
And
like the price of gasoline. One day you go to the pump and it's one price, and the next day it could be something else, and we don't really have a lot of control over that. So sticking with it and just being confident that this is where I'm at, and I'm working towards getting that approval and getting locked in so that I know what it's going to be.
yeah, Good point. And we also talked about just comparing loan estimates. So
Yes.
typically through pre-purchase counseling, right? We drill in the
Mm-hmm.
three minimum everything, three choices of everything, three choices of lenders, three choices of realtors, three choices of insurance agencies. So you can compare apples to apples and know if you are getting in fact the best deal for your household,
It
right?
is, and the same thing applies. The lenders use that three-time rule, or we are under that rule when it comes to the appraisal, the value of the property that's being financed, because we don't have control, but it is sent through a third-party appraisal company to get three different bids on doing the appraisal.
Hmm.
And then it comes, it comes back. But it's important that it all remains, because you don't want the lender picking out who's going to appraise the property and then it not meeting the value for whatever. And I'm venturing off into the appraisal portion, but it's good to get three bids whenever you're replacing something in your home.
Mm-hmm.
Your roof has a leak, you get three different contractors. The same thing with your car. You damage your car, you usually get three people to tell you how much it's going to cost to get it fixed or what's wrong with it. So, anyway,
Yeah.
yes, I think that's a really important.
Solid information. And then just knowing that you can with credit inquiries, yes, there will be three inquiries, but when you do it in a limited amount of time, like in 30 days, remember that well, Cheryl, you were not here for this part, but we saw the FICO distinctive categories that measures your score. And we learned that payment
Yes.
history and credit utilization carry the biggest weight. So even when you have a new credit inquiry, it's 10% of your score, right? But it's the difference between doing a hard inquiry today, another one in 30 days, another one in 60 days. So you want to do them
Right.
all on the same week. It's recommended that you get three loan applications submitted within the same week so that you try to make sure that that 35% payment history, that 30% credit utilization really carries a weight for your credit score forward and doesn't, yeah,
Absolutely.
impact it negatively. So, one last question here on this slide. Do you have to pay a fee to lock your loan rate? And for those of you following along on your ebook, page 66 and 68, you see the copy of this loan estimates. So, do you pay a fee to lock your loan rate?
If you lock the loan payment for the going rate, no, but they usually will give you an option to buy down the rate. And if you buy down the rate, there's a fee to purchase a lower interest rate.
Mm-hmm.
It,
Thank you for answering that. And as counselors, we're happy to walk you through your loan estimate. If you already, I think I believe I had three, Cheryl, that had pre-approvals already. And so,
mm,
for those of you on the call that have a pre-approval, your loan estimate is something that we can review together during your pre-purchase housing counseling. All right, I'm moving you along to PITI, Cheryl.
which we kind of looked at briefly, but it was the principal, the payment on the amount that you borrowed. So the principal is just that if you borrow $100, the principal is $100. The interest is the payment on what the lender charges for the loan. So if you borrow $100 and the interest rate is 10%, then it's $110, and that's the interest is that $10. The taxes are the payment on the property based upon the assessed value of the property for your area. So again, the county comes in and assesses. They assess the property based on a tax value of what the property is worth, and in doing so, they take that and multiply it times um, a rate that's charged for all homes, and they're going to base it upon the size and the value of your home. So that can be, you hear people saying, I'm protesting my taxes. Well, you can't do it before you buy a house, but because it is whatever it is for that current year, because they have a cutoff every year. But in future years, you can. The value of the property is, um, it's what it, I guess. I guess the best thing to say here is that your value of your property for your appraiser, you want it to be as high as absolutely possible. And for paying taxes, of course, it's like any other taxes. We all want those to be as low as possible. But whatever the property taxes are based upon the value at the time that you're purchasing it. And they're going to divide those up, and that'll be escrowed. Your insurance is the payment on the insurance policy or policies on your home, just like your car. So it's principal, interest, taxes, and interest, PITI. Your PMI is your private mortgage insurance. That's used only on conventional loans to protect the lenders from the risk of default. That was that 20%. They determined that 20% is the average amount that once you've put 20% into the house, the chances are you're not going to lose it. It's kind of like paying on your car. If you've got you have a lot of equity in it, meaning you've made a whole bunch of payments and you've got that equity in there, you're not going to risk losing it. So the private mortgage insurance covers that until you reach that 20%, versus your MIP, which is your mortgage insurance premium. That's funny, but anyway, I'm dyslexic, but that's used in FHA loans. If your down payment is less than 20%, you pay MIP for the life of the mortgage loan unless you refinance it. If you refinance it and you've paid down more than 20%, then they can drop the MIP at that point. Other possible costs: condos have monthly association dues, fees, or common maintenance charges. Homes in flood zones may require flood insurance. We are in Houston, Galveston, Montgomery counties here, but we're in Harris County, and there's a lot of properties in the flood zone. So it's very, very important at the beginning to find out if the property that you're purchasing is in the flood zone, and to obtain flood insurance, because that is mandatory for properties. The condos and the condo association, those are unique to each entity, each group of houses or condos, and they have their own assessments. And those, just because you purchase a home that has a X number of dollars for 1 year, those can go up or down depending upon what their maintenance charges are for those. So it's just something else to keep in mind, is you might want to look at the historical cost of those. Have they gone up or have they gone down? And usually they don't go down. But just to know what's prefacing that, what caused it to go up or down. And next slide.
We do have a hand up. Cheryl, do you want to take a question?
Yes.
Miss Stephanie, would you like to come off mute?
Yeah, this is going to be too much to type, so.
Hey.
So, hi, Miss Cheryl. Quick question on that. I'm looking at what you were stating on the FHA loans. So, if we were able to get 20% down, we wouldn't have to pay the MIP. But if we don't have the 20% and we get that loan, once we get to the 80% of the loan, it won't drop off like a conventional.
That's correct.
Okay.
Okay, homeowners insurance. The homeowners insurance declaration page. Well, number one on there is the name of the insured. That's going to match, and it has to be exactly the way the loan is applied for. So if it's joint, you need both everybody's name on there, and the property address. Number two, the policy period. It's showing 12 months. They're going to require a year at closing. So your effective date is when you insure it. That's, as of the date when you're buying the house. The expiration date, 1 year. There's your personal property, the minimums, the dwelling coverage that we talked about. There's your deductibles that are in there. That's important to know. Those, your liability. And then you see down at the bottom, there's like a rider for jewelry or any other things you have on there. They do give discounts for home security systems, storm shutters, sometimes loyalty, and sometimes you can even get a discount if you combine those. It's kind of like your cable and some of those things. If you combine your homeowner's insurance with your car insurance, sometimes but that's up to your agent or adjuster or whatever company you're looking at. The lenders require the homeowner insurance so that the property they have an investment is fully covered against catastrophic damage. Houston, we are known for flooding, hurricanes, you name it. The appraisal. The lenders want to make sure that the home is worth enough to guarantee the loan. An appraiser assesses the fair market value of the home. Who orders the appraisal? The appraisal is ordered by the lender. They send it out. They get 3 bids. So how much does it cost? They're gonna give that to you. That'll be part of in your closing cost estimates. But who pays for the appraisal? That's going to be dictated. That's generally the buyer's going to pay for the appraisal. If the house appraises below the purchase price, that means that you're paying too much for the property compared to similar properties. If it appraises for more, can the seller increase the price? No. If I come back out of contract, do I still owe the appraisal fee? Yes. But once the appraisal, once it's paid for, it's yours. You have a copy of that, and it's kind of like your car. It's like the NADA value in your car. That's something that goes with that property. And another thing to understand with the appraisals, they typically do not, whatever is inside the house, as far as like, if you have, 14 Garrett gold plated doorknobs, they're not going to count that. They're typically, the appraisal is looking at square footage and basic comparable amenities, bathrooms, the square footage, bedrooms, that type of stuff. They're not looking that the appliances and whatnot, the built-ins, they're not going to give you extra because you have a certain type of amenity that's added in. It won't affect the appraisal anyway. I thought that was interesting. Mortgage underwriting is a process the lender uses to take an in-depth look at your credit and financial background to determine if you're eligible for the loan. Don't apply for any new credit lines during underwriting. That was don't buy furniture, don't do anything, don't buy any cars. Avoid making purchases that can decrease your assets. Don't close revolving accounts or credit cards. Even if you get an account that's, the revolving account and it's paid to zero, don't close anything. Don't co-sign any loans for anyone. Don't make any employment changes. Stay current on your existing account. All of those things, because it'll stop the process and then they have to go back and start over again. If your underwriter determines your loan's approved, then woohoo, we're clear to close. Clear to close. Clear to close is,
and worth celebrating.
The majority of the mortgage process is now over. You're in the home stretch. The lender's ready to move forward with a closing date and the title company. At this point, you're going to receive a disclosure. And that disclosure is probably the most important piece of paper for the purchaser. The closing disclosure, the estimate versus the disclosure. The estimate is just that. It's an estimate. The closing disclosure is the final, this is what the transaction looks like from then on. And the lender provides the amounts versus the monthly payments. It's the final numbers, and your interest rate is, if your interest rate is not locked, it can still change at the beginning. This now shows you exactly what it's going to be. And going through that. Next screen. The note. The promissory note is a legal document that sets out the term of the mortgage between you, the borrower, and the lending institution. The lending institution holds the note. What's on the note? It's got it's your promise. The note is a promise to pay. It's your total amount of the home loan, whether monthly, bi-monthly payments are required, the dates when the payments are due, whether the interest is fixed or adjustable. We talked about the differences in those. And are there any prepayment penalties? Some notes, and that's an important one. If most loans do not have prepayment penalties, but you need to look for that if it's in there. That means if you prepay the loan ahead of time, you're going to be penalized. And the length of the time for the repayment. Whether the loan term's a 15-year, a 20-year, or a 30-year. Most of these will be 30-year mortgages. On closing day, when they schedule you for closing, this is when the title to the home officially transfers and you become the legal owner of the property. You have reached the long anticipated day. What to bring? You need to bring a current state photo ID. That's, bring your driver's license, bring your ID, bring your whatever you have that's your formal identification. Your cashier's check or wiring instructions. The title companies are pretty good about obtaining wiring instructions from you. Your wiring instruction is the routing number for your bank and the account number for wherever the money is coming, the account the money is coming out of. This is pretty important because if you're taking money out of a retirement account, say, or you're transferring it from some other account, or it's being gifted to you, you will need to have those funds sitting in the account for a period of time. And you should, talk with your realtor about this, because you do not want to be at closing and find out that it's going to take 3 or 4 more days to wire the funds. Then a personal check. A lot of times the personal checks, they usually won't take a personal check for more than a few $100s at the title company. That's just because of fraud. and whatnot that's been rampant, and the executed sales agreement. And then who will be there? You and your spouse, if you're married, whoever's going to be on that loan and a part of that property, if you're married. And remember when I said that sometimes even if you're married, even if he's not on or she is not on or the significant other is not on the actual note that responsible for the loan, they still have to be on the deed of trust. And if they're counting their income, the lender's going to require that they be on the loan. Your real estate agent and the closing agent, usually the title company officer, contact your lender the day before and on the day of closing for any last minute requirements or changes to time so that you're not there. It's kind of like a doctor's office. Sometimes they get backed up at the end of the month. But schedule a final walkthrough immediately before the closing. Make sure nothing's changed, nothing's happened. A lot of people will find that you get down to the wire, and if there's and we've all heard these stories, but it's you get down to the wire and there's a hurricane that's in the middle of the Gulf, and it's been something catastrophic is out there. They have to wait until it's through. But you want to make sure the final walkthrough that you didn't miss anything, and that everything's as it was when you first decided you were in love and wanted the house. You can't, now it's not the time to change anything, but ask for the keys, security codes, garage door remotes, original warranties for any appliances or any repairs, anything that goes in there. If they have extra, if you've got wood floors, ask if there's any extra thing. Same thing, paint, if there's any extra paint in the garage. Anyway, I think if everything is in order, you're going to sign all your documents, your keys, and just like that,
voila,
you're a homeowner. Yay!
So I love how you said, just making sure to check on the house. Like, check on the house. Earlier we talked about, like, if you're buying a home with appliances, to just make sure that those appliances are still there during the final walkthrough so that you're not walking in.
Air conditioner's still there.
Yeah. Lots of things can happen, like you said. So let's see. Now you're a homeowner, guys, and we're going to do a couple final questions. Miss Peace, I do see your question about homestead, and we'll talk about it during the next few chapters, so I'll come back to it. I do have one question from Melissa Cheryl. Would I need to show the sale of my late father's house that we sold a few months ago? It was paid off property, so there was no mortgage on it. And her question is coming from the slide we saw with a copy of a settlement statement.
Okay. If you're needing it, that would be the underwriter way back when they were qualifying you for the loan. When you made the application, they may ask you, where did the money come from? And when they see the bank statement, they're going to ask, and they're going to ask that of everybody, where did you get the down payment money? And if it's inherited from the sale of a home, then they may ask to see that.
Okay.
But other than that,
yeah, that's what I thought.
No.
Okay.
Yeah.
All right. And then I have one question from Karima. She's clarifying for the resolved or unresolved credit dispute documentation, does it have to be within a 2-year time frame from the date of applying for a home, or is there a time frame, Cheryl? If I have a account in dispute, is it just waiting until the 90-day investigation is concluded, or is there a wait time that I should wait until I apply for a loan?
A dispute on your credit report, you would have to wait until it's resolved, but I do believe that they can. I do believe that you could go ahead if it's something that
Can you take like a letter of explanation?
exactly. Exactly. I think that you can go ahead and apply for the loan, and then the letter of explanation would prevail there, especially if it's something I didn't buy or something that was fraudulent.
Right. Right.
But it showed up.
Okay, and then for this final question, before you leave us, I know Nate, Mr. Nate, I saw your question come in. I'm gonna ask that you share your question more specifically so that we can understand what's being asked. So one of the questions was benefit to being married. Is there a benefit to being married or unmarried if we are both on the home loan title and contributing 50-50? So if you don't mind just coming off of mute to elaborate on that question as we wrap up in the next minute.
Yeah, we were just wondering if there was any type of like benefit if we're just buying the house together but we're not married yet. Is there a benefit to being married before?
To being married before or not married, you can buy a house with the promissory note is a binding contract. You could buy a house with a child, with with whomever, but the marriage thing is it that goes into the community property. That's in the case of, that has to do with community property and rights to the property. Mm-hmm. It doesn't really have anything to do with as far as the lender and underwriting, we're looking at just the borrower versus the borrowers and their income. So it would depend upon, the income.
I see. So it sounds like, Mr. Nate, it sounds like you may benefit from, it's more like of a civic question. So in terms of Cheryl's just answering the benefit of being married or not, it's not really a benefit to the lender to recognize marriage because, like she said, it's like the income specifics, DISC, debt, income, credit, savings. So when two people apply on a loan, regardless of their relationship, both of their DISCs is considered. And then really understanding like your question, the part 2 of your question is what's the benefit of marriage and buying property together? That's more of a civic question. And we do work with like different agencies that provide legal counseling. So you may benefit from having a conversation with them. Yeah.
I was looking for that word, civic.
Yeah. Thank you so much, Cheryl. All of you guys asked amazing questions too. We really appreciate you sharing some of your Saturday time with us, Cheryl, and I hope I see you soon.
Absolutely. Thank you.
Yes, I'll see you soon.
Okay.
All right, ladies and gentlemen, let's give her a round of applause. You can drop your emojis in the chat.